Australia's most expensive suburb just lost more than a quarter of its value in 12 months. Toorak, Melbourne, down 26.6% over the year to a median of 3.67 million, and that's according to Domain's June quarter house price report. If you own a property or you're sitting on a deposit waiting for your moment, the next 6 months decides which side of this you end up on, because the falls are not landing everywhere at once. They're landing in specific streets in specific property types, and the pattern is repeating in 7 pockets around the country right now. Nationally, home values fell 0.7% in July, the biggest single monthly drop since December 22, and that came straight after a 0.4% fall in June. But here's the part the headline number hides. Over the 3 months to July, the most expensive quarter of Australia homes fell 3.2%. The cheapest quarter over the same 3 months, up 0.3%. So the top end is falling roughly 10 times faster than the bottom end is rising. Sydney fell 0.6% in the month and had its worst auction weekend since April 2020. Remember, that's when everyone was locked at home, with clearances around 52%. Melbourne is sitting about 2.2% below its late 2025 peak. Brisbane and Adelaide both posted their second straight monthly falls, and the regional index fell 0.2%, the first regional decline since January 2023. Same direction, 4 different measures. So today, I want to walk you through 4 things. Why the expensive end of the market always goes first when credit tightens, the tax law that passed the Senate in June and what it did to the investor bid, the 7 suburbs where the cracks are already showing up in the sales data, and how all of this lines up almost perfectly with the 18-year real estate cycle. So let's get straight into the data. The cash rate is at 4.35%. That's after 3 hikes in February, March, and May of this year, adding 75 basis points, which completely unwound the cuts everyone was celebrating in 2020. Now, borrowing power is just the maximum a bank will lend you after the stress test of your income against the higher rate than the one you actually pay. When the cash rate goes up, that number comes down, and it comes down harder for the biggest loans. So a buyer who needs 600 grand loses maybe $60,000 of capacity. A buyer who needs 2.8 million for a lower North Shore house loses several $100,000. So the top end of the market gets repriced first and fastest. You can see it in the lending numbers. New loan commitments fell 6.2% by number in the March quarter, down to 140,000 and 3.8% by value. Now let's be fair here. That quarter came off a record December, and the annual comparison is still positive, but the direction changed, and it changed at the exact moment listings started climbing. There were nearly 250,000 homes listed nationally in June. That's up 6% on a year ago. New listings alone came in at 69,200 for the month, up 10% year on year. More sellers, fewer approved buyers. That's the whole equation. And it gets uncomfortable when you look at what isn't selling. Stale stock, meaning homes that have been sitting on the market for over 180 days or more, hit nearly 74,000 properties nationally, up 10.5% in a single month. So who are supposed to soak up all of that inventory? For 20 years, the answer in this country was the same group every single time: investors. And that's the second thing that changed. On the 12th of May, in the federal budget, the government announced it was rewriting the tax treatment of investment properties. On the 25th of June, the bill passed the Senate. This is not a proposal anymore, it's now law. From the 27-28 income year, negative gearing on residential investment properties is restricted to new builds and designated affordable housing. For everyone new to this, negative gearing is where your rental property losses on paper mean you can deduct that against your salary and cut your tax bill. For established dwellings bought after budget night, that deduction against wages is gone. You can only carry the loss against other property income. The 50% capital gains discount is also being replaced with cost-based indexation plus a 30% minimum tax rate starting 1st of July 2027. We've all heard about that before, hopefully. Now there's a carve-out, because there always is. Anything bought or contracted before 7:30 p.m. on the 12th of May is grandfathered under the old rules. So the people already holding the stock keep their shelter. The next buyer doesn't. Well, thanks for that, government. Westpac now expects new investor activity to fall 34% and total housing turnover to fall 20%. CBA estimates the tax change alone takes about 3% off prices over 3 years and hits apartments and townhouses the hardest. And the Westpac Melbourne Institute House Price Expectations Index, that's a damn long one, dropped 4.9% in June to 128.2. That's the first time in nearly 3 years it's been below its long run average. Here's why that matters more than it sounds. In a normal correction, investors are the ones who step in and buy the dip. This time, the tax shelter they were relying on is being switched off just as the market rolls over. Great timing. Thanks, government. And the sellers, they obviously already know this. Auction clearance rate is just the share of homes that sell under the hammer on the day. Above 75% is a strong seller's market. Between 65 and 75 is roughly balanced. Below 60%, and buyers are running the room. Sydney printed around 52% in July, the worst weekend since April 2020. Melbourne's combined clearance dropped to 47%, also the lowest since the 2020 lockdowns. And PropTrack found that 93% of Melbourne suburbs, 369 of them, recorded falling house values in a single quarter. Then there's the number almost nobody is reporting. Distressed listings are up nearly 11% nationally in the latest month tracked. In the ACT, distressed listings are up 44% year on year. So just hold that one on for just a sec because it comes back later on in the data. Here's how this actually plays out in the household. A seller lists at last year's price. They get no offers for 4 weeks. They cut 50 grand off the price and they blame the campaign. New agent, fresh photos, another price cut, and eventually they either accept the market or they pull the listing and rent the property out. That's not a crash, it's in an unwind phase. Now, I've been running national numbers this whole time and the national numbers are lying. So let's pull it apart suburb by suburb, property type by property type, starting with number 7, New Farm in Inner Brisbane, one of my old home cities. This is the most controversial one on the list and I'll tell you why up front. Domain has the Brisbane inner region which covers New Farm and West End down 15% in the June quarter alone. That's 350 grand off the median in 3 months to 1.9 million and it's the sharpest quarterly fall recorded anywhere in the country. Inside New Farm itself, 2-bed houses are down about 20% over the year. But that's on 10 sales. So treat it as a signal, not a valuation. There's really not enough data there. And the suburbs overall house median is still up 22% year on year. So call it what it is. A boom top rolling over, showing up in the freshest data we have. Number 6, St Kilda in Melbourne. House median around 1.5 million, down 11%. 4-bedroom houses down nearly 11% on 13 sales, taking 40 days to sell. 3-bedroom units down nearly 10%, but the overall unit median in St Kilda is up 2.4%, with 1-bedders up 2.6%. That's the same suburb, opposite directions, and the difference is size and price point. The broader Port Phillip region fell 9.7% in the June quarter. That's 173,000 gone in 3 months. Number 5, Greenwich on Sydney's lower North Shore. Houses down roughly 16% over the year on 34 sales, median around 3.5 million. 4-bed houses down about 20% on 12 sales. Gross rental yield on those houses only around 1.8%. Meanwhile, Greenwich units are up 9%, and the wider Chatswood Lane Cove region fell 5.4% in the quarter. That's 200 grand off a $3.5 million median. Number 4, Darling Point in Sydney's east. Units and only units because the house data there is built on 12 sales, and that's not good data to work from. The unit median is down about a fifth over the year on 126 sales to roughly 2.4 million. Yield of about 2.5%. That's the cleanest premium apartment decline in the country, and it's got the sales volume to back it. Number 3, Harrison in Canberra. I mean, but who actually cares about Canberra data? No offense. Unit median around 490 grand, down 13%, and 64 sales, 50 days to sell. 1, 2, and 3-bedroom units are all lower. Houses in Harrison are up 3%. Sorry, Canberrians? Fill me in the comment section. Number 2, Greenway in Canberra's south. All right, let's keep going with Canberra. Unit median around 550 grand, down roughly 9% on 135 sales. That's the biggest transaction sample on this entire list, which means it isn't a statistical fluke. Houses in Greenway are up 2%. And remember that ACT distressed listings are up 44%. Domain also has South Canberra, that's Red Hill and Yarralumla, down 6% in the June quarter. Canberra isn't collapsing, Canberra apartments are repricing while family houses hold. And number one, Port Douglas in far north Queensland. Beautiful, beautiful place. I don't know if you want to live there year round. House median just over $1 million, down around 14% over the year on 49 sales. But the number that puts it top of the list isn't the price, it's 99 days. That's a median time to sell a house up there. It's over 3 months. Compare that to 24 days in Greenwich and 27 days in Darling Point. Units in Port Douglas are only down about 4%. This is a lifestyle and tourism market. Second homes, holiday rentals, relocators. Nobody has to buy in Port Douglas. And when finance costs rise, discretionary demand is the first thing to go quiet and the last thing to come back. Notice the pattern across all 7. Premium houses, low yield apartments, and discretionary locations are falling. Affordable units, family houses in stable job markets, and the bottom price tier are holding or rising. Downturns don't arrive as one national event. They roll over one segment at a time, starting with whoever needed the biggest loan or had the weakest reason to buy. By the time the national headline confirms it, it's already happened. Now, none of this makes complete sense as separate events. 3 rate hikes, a tax overhaul, clearance rates under 50%, and premium suburbs cracking across Queensland. Sydney, Melbourne, and the ACT. They only click into place when you see the pattern running underneath them. Real estate moves in a rhythm of roughly 18 years. It's about 14 years up and 4 years down. Fred Harrison mapped it in the UK and Phil Anderson refined it using the US land sale data going back more than 2 centuries. That framework was what led Harrison to call the 2008 crash 3 years before it landed. Anderson has had 2026 circled as the peak window for over a decade. Australia's last major property bottom was around 2012. So we count 14 years up from that and we land right around now. The final stretch of that boom has a name. It's the winner's curse. It's where the last buyers pay the highest prices with the thinnest deposits at the worst possible moment. And every pillar we just walked through is that phase in action. Credit coming out of the system through 3 rate hikes, the tax shelter for marginal buyers switched off, and the most expensive quarter of the market falling 3.2% in 3 months while the cheap end still climbs. Every cycle peak produced a story explaining why it couldn't turn. In 2007, it was the Great Moderation. In 2021, it was low rates forever. In 2026, the story is that Australia has a structural housing shortage, so prices simply cannot fall, which is a genuinely good argument. So let me argue it properly. You know, it's a logical idea, it's a logical thought. I'm not here to sell you the doom. The shortage is real according to the government numbers. Rental vacancies are tight and migration is still adding households faster than we're approving dwellings. We talked about this in last week's videos. Perth is still up 20% over the year and Darwin is still rising. Westpac has Perth up 13%, Brisbane up 9%, Adelaide up 7% for the calendar year, even while it has Sydney down 3% and Melbourne down 4%. HSBC's Paul Bloxham sees this year roughly flat before any weakness in 2027. SQM has trimmed its national forecast to 0 to 3% growth, which is soft, but it's not a complete collapse yet. So, of course, I could be wrong and we've got to look at both sides of the argument, but I'd rather be prepared and a bit early on this one than caught out completely. When you weigh it up though, the negatives outnumber the positives at this stage of the cycle. Signal 1, the top price tier fell 3% in 3 months, while the bottom tier rose 0.3%. Signal 2, listings are up 6% year on year with Melbourne clearance at 47% and Sydney at its weakest since 2020. Signal 3 is the tax rules that supported the investor demand for the 40 years are now legislated out, with Westpac tipping investor activity down 34%. 3 independent forces pushing the same direction. And underneath it, rates are not confirmed as finished. Headline inflation eased to 3.8% in June, but the trimmed mean is stuck at 3.6%, which is still above the target. CBA, NAB, and ANZ all expect the RBA to hold through the rest of this year with cuts pushed into 2027, which is a similar view that we've been holding now for quite some time. Westpac is the outlier and they're tipping the rate, the cash rate could go up to 4.85%. Roughly 55% of economists surveyed still see the hike risk this year. So Here's what to actually do about this. If you own your own home and the repayments are comfortable, you don't need to panic. You're in the strongest position of anyone watching. But don't build your plan around a rate cut arriving in 2026, because 3 of the 4 big banks have already moved that to 2027. And from the data that we're looking at, we also think that could be somewhere out in 2027 as well, for larger rate cuts, that is. If you're sitting on cash waiting to buy, patience is the play right now. If you're watching a market where premium homes are taking 40, 50, and even 99 days to sell, stale listings are climbing. Every one of those days is negotiating power moving toward you. But don't catch a falling knife on the first good auction result, because buying at the wrong point in this window can cost you years just to reach break even before you've even counted stamp duty. What you should do right now is go to open homes in the suburbs you actually want. Talk to agents and find out how many listings have already had a price cut. And if you're an investor carrying leverage, understand exactly what changed. If you bought or contracted before 7:30 p.m. on the 12th of May, you're grandfathered. If you're buying an established dwelling after that, the deduction against your salary is gone from 2027, 2028 income, and the CGT discounts change from July 2027. So you need to be looking for positively geared properties, or as close to that as possible. Don't over leverage into a market where your safety net has a legislated expiry date. 3 things I'd watch from here. Watch the gap between the upper and lower price tiers, because if the bottom tiers turn -2, this stops being a premium correction and becomes a national one. Watch auction clearance rates, and specifically whether Sydney holds above 50%. And watch listings and days on market in your own postcode, not the national number, because that's where your price actually gets set. Those 3 will tell you whether you're right, early, or completely wrong. And if you do think I'm wrong, please leave your take in the comment section. I read every single one of those and I reply to almost all of them. If this helps you see where the cracks actually are, hit the like button, subscribe to the channel. I cover charts, stocks, commodities, and Bitcoin over on my other channel, Jason Pizzino. There's a link to that in the video description. I'll see you guys at the next video with more updates, charts, and data. But until then, take care and peace out.